Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Welcome to Real Estate Risk Report. I'm your host, Lance Pederson. Today I have with me Devin Elder with DJE Texas Management Group based in San Antonio, Texas. How you doing today, Devin?
Hey, Lance, doing great. Thanks for having me. How are you?
I'm doing good, man. Yeah, my pleasure. Thanks for joining us. So before we kind of get started here, why don't you maybe just give us a little bit of background of sort of how you got into real estate, what your journey was, that brought you to a position where, you are today, where you're, doing multifamily syndications and, and have a property management company and all those things. So kind of give us that bit of that origin story to set the table, and then we'll dig into, risk and risk mitigation and, all those things that come along with it.
Yeah. Outstanding. So I had a pretty, I would call traditional trajectory initially. I got my college degree, went to work for a big tech company here in San Antonio. This is a big San Antonio success story. And I was pretty gung-ho the first couple of years in my corporate career. I was excited to be working for this big company, and I had a lot of energy and ambition, and that sustained me for a few years, but the sheen started to wear off after a few years. And I would get a little promotion here and there and a little bit better title maybe, and more hours and more stress. And it just kind of inherently seemed like a limitation to me. I've always been ambitious. I've always had an entrepreneurial kind of bent, and I've always kind of worked multiple jobs in my life, or gone to school and had a job. So I've always liked to be busy, but I just kind of ran into this math problem in a W-2 situation where you work 10 hours a day. I can't make it 100 a day. Right. And so you start looking at, I think asking the question, how do I 2X my income? Okay. I could probably make a path to that. How do I 5X it? Oof, I'm really going to have my boss's job, and that's going to take a long time. And how do I 10X it? Well, I'm going to have to get lucky with some equity. And at some point in my career, I just realized I was not on one of those ships that was going to deliver that. So I started looking to be an entrepreneur. I was not really looking at real estate, but I started reading a lot of books around entrepreneurialism, and et cetera. And then I, went to a seminar one day on real estate, and it just clicked for me. I said, this is it. This is going to be my thing that I do to do what I want in terms of income and freedom, and real estate was going to be it. So I started going after it pretty good after kind of attending that first seminar, and bought a little rental house. That kicked it off, and I haven't really looked up or stopped since then.
Yeah, no, it's not yet. And it seems like that is sort of the entry point for many. And I mean, which makes a lot of sense, because it has, a single family rental has all the fundamentals, right? Of what, you got a location, you got to buy right, you got to finance it right, you got to, all those sorts of things. So I think it makes a lot of sense. And then obviously that journey, goes on its way to, it starts to realize that, hey, underwriting one home is X amount of work. I could underwrite sort of 150 unit, apartment building or apartment complex. It's not too different. It seems where people, kind of land in the multifamily syndication. So it sounds like for you guys, that's what you exclusively do, sort of value add multifamily stuff, or do you do development or redevelopment or anything like that?
We've got, I've done a lot of projects over the years. We do some land stuff. We're building a few houses, just ground up. We've done, I spent several years flipping houses. I mean, this is kind of my start in this business, probably too long and did too many. But today, most of our focus is on 150 to 250 unit apartment complexes in Texas. I like that model for a lot of reasons. We'll do the occasional outside the box deal, a lot of times in my own account, or maybe with one other partner. But for the most part, it's these, especially what we're syndicating and bringing investors on, it's these larger multifamily deals is really where we're almost exclusively focused today.
Mm-hmm. Are there particular markets or submarkets I mean, Texas is a big state, but are there certain areas that you guys sort of hone in on, and that's kind of your territory, or how do you guys approach that?
Right. San Antonio is definitely our territory. And even we had an investor over at the office today. We're talking about it. It's kind of this cone from downtown north.
Yep.
Well, like if you look at a map of our assets, It's kind of all right north central San Antonio, and that's for a couple of reasons. I love Texas as a market. I like San Antonio. We fly under the radar a little bit next to Austin, which is absolutely on fire. Dallas, Texas, Houston's large market. San Antonio is a little bit slower, which I like. A little bit less competition, I think, kind of nationally. But we're known here and we know it here, right? We in terms of all the vendors, in terms of all the brokers, in terms of the assets themselves, something comes up from a broker, we go, oh yeah. I'll give you an example. We're closing a deal this year, buying it from a friend of mine, right? I've been following that asset for 5 years. And so it just eliminates a lot of the complexity of being in multiple markets. We're also vertically integrated with our management company. So the track we've been on is just growing in our hometown, and it seems to work. We do one deal at a time. We're not trying to have $100 trillion under management or anything like that and own the world. We just want to do one deal at a time that makes sense in San Antonio.
So when you acquire these, they're like, what's the depth of the value add? I mean, like how much per door are you generally putting into these deep value add? Or what does that look like?
Yeah, we've gone as high as 45,000, right, per door. That's an anomaly. Our bread and butter would be like $5,000-$6,000 a door renovation, really kind of lightweight. Because if we can go in and do floor, paint, fixtures, resurface counters and cabinets, and we can get $100 rent premium, something along those lines, that's probably going to work for us if we can buy it at the right price. And the buy price is kind of in the 60,000 a door to 100,000 a door. I know that's a huge range, but just kind of depending on the vintage, that's kind of what we're targeting.
Mm-hmm. So for you guys in your acquisition strategy, since you have sort of honed in on, what is it, the Anderson loop, isn't it? What's the loop that goes around? The 16.
Yeah, nobody calls it Anderson loop, but that's right. Yeah.
Yeah.
I had to think about it.
Yeah. I mean, I've been there a few times and I've always appreciated how, it's always nice to get a bunch of flat land to sort of lay out the most efficient way to kind of get around a metropolis. But I've always appreciated how San Antonio's done that. But so you've sort of narrowed in, like you said, the cone kind of going from downtown sort of, north. But how do you guys, like, how do you go about kind of identifying those potential transactions? Are you reaching out to the owners? Are you before? Are you just, like you said, the brokers sort of things, come on the market? And then I guess what I'm trying to get to is sort of the assessment process. How do you determine whether there's a deal there or not? Right. What does that look like?
Yeah, great question. So one of the nice things about operating in almost exclusively in one market is that we've got a database of all the assets we would buy. So we've got data on what the loans look like, what the taxes are like, what the ownership history is like, what the median income and crime in the area is. So there's kind of baseline foundation on several hundred assets that we'd be interested in, period. So most of the time, if a deal comes from a broker, it's really like, oh, here she is again. We've looked at this. It might have been a few years, but they brought this out for sale 2 years ago, or we know the owner of that one, or whatever the case is. So there's kind of a baseline understanding of the asset. And a lot of times we can shortcut a lot of things by seeing just the area of town and going, oh no, we'd never buy that. Right. Plain and simple because of the area. Yeah. So a lot of that local knowledge is really helpful. It cuts out a lot of cycles. Most of the stuff does trade through brokers, right? Mm-hmm. Even though it's a limited number of assets, and we do call on owners for sure. And we buy direct principal to principal transaction. But the truth is most of it historically has gone through brokers. So we work on our broker relationships as well, because like any city, there's really only a handful of guys that are trading most of these deals. So it's kind of an 80-20 deal. So we know those guys on a first name basis. And the thing I think that helps us, there's the acquisition side, and that's understanding. We kind of have this target of a relatively small pool of assets we'd like to buy, and then knowing who's brokering that, and then them knowing that we close and we don't mess around. Because last thing you want to do on a $10 million transaction is get into contract and do inspections, disturb all your tenants, and not close. We've been on both sides of that, right? We've sold deals where a buyer couldn't perform, and we've always performed on the deals that we transacted on. But what does a broker want at the end of the day? They want a buyer that can transact. So we've worked really hard on being that buyer, easy to work with, because these brokers have a lot of discretion in where they steer the deal, right? It's not always necessarily a price thing. It's ability to execute. So we spend a lot of time on broker relationships in order to make that happen. And then also, our philosophy is one deal at a time. So we could put all our energy once we get an accepted LOI, a letter of intent. We can just kind of put the brakes on everything and say, all right, we got our heads down here for the next 6 weeks while we get this thing hammered out. Make sure it stays on track, and then we've got a successful acquisition process. And then we kind of come up for air and say, okay, what's the next project? And that's been a nice way to work, where we can just kind of focus on one project at a time.
So from your perspective as an active investor, what is the thing that makes you most nervous about execution then, right? I mean, because, I think that is the benefit, like you said, is being in a market you're really familiar with. So you know what you got. You really know the market. You probably have a better sense of the how realistic, moving those rents are, where they're at. But then now you've got this asset. It's not core. It's not stable. And obviously that's the whole point here, is to sort of drive value, to bump rents or decrease expenses or whatever. But for you, what is the thing that makes you most nervous? I mean, once you got the transactions, when the game begins, right? So what sort of keeps you up at night, or the thing that you're really laser focused on making sure that you don't goof up?
Yeah, so I've probably been desensitized to a lot of the the issues that can come up in multifamily, because they've all happened, right? We've had fires, we've had shootings, we've had lender issues, we've had property management issues, we've had staff issues, we've had capitalization issues. I mean, kind of you name it. It's come up in the past. So one of the big ones is a loan maturity, right? So if you're in some sort of a debt and you're inside of 2-3 years on a loan maturity, I've seen other operators get burned on that. Now, I'm not completely opposed to a bridge product, right? If you're going in and getting short-term bridge debt with a 3 or 5 year maturity, but that can trip people up when you're coming to market and you have like a hard you have the loan balance due in a matter of months. We've never been in that position intentionally, but I've seen that hurt some folks. So that's a big one, right? Loan maturity. The other one that we're very cognizant of is just the capitalization. It's a balancing act, right? I mean, every dollar of equity you raise in the project, you've got a pretty big payout to investors on. So you don't want to raise too much, but you most certainly don't want to go into it undercapitalized. And one of the things that I like to find out as an LP myself is basically the liquidity of the sponsor, right? And because you can put together a multifamily deal with other people's money and not have, a lot of other capital left. And I don't want to be an LP in that situation. And I don't want to structure my deal that way, because a lot of times, multifamily deal, to spend $100,000 getting something done is really nothing. Right. And so if you've got, let's say, $500K locked up with the bank in an escrow, and you need to pay a contractor $100,000 before you get the bank money back, you don't want to be in a situation with a sponsor that doesn't have $100,000 laying around to just cover that. They're coming back hat in hand to investors with a capital call over $100,000. That's not a situation you want to be in. So we like to be well capitalized on the property, but then myself as a principal, if there needs to be something like we're fronting, finishing a renovation before we get the bank draw, that, I've got the wherewithal to do that. And I think that's very important, because the last thing you want to get into on any construction project is the guys aren't working because we can't pay them. That's just the worst situation to be in. And it happens all the time to people because, you know, in any business, right, it's going to have a cash flow constraints at times, but you have to be able to pay those guys, keep them working in order to get to your bank draw or whatever the case is. So loan maturity is a big one. Capitalization, being properly capitalized at the property level, but then also at the sponsor level. I think the sponsor's got to be able to have some liquidity to push some of these things through if need be.
Yeah, you know, and that's a big part of the predicament, right? I think with this business, I mean, yeah, the returns are super attractive, right? I think that obviously there's a hard asset behind it. There's so many things that are good about it, but it is this capitalization issue of, you know, you gotta pour through. You got to look at so many deals before you find one and get one under contract, right? And then take it down, and you know, and then you've got to rush to basically raise the equity, right? People want to know that you got the deal, right? It's just a really tight turnaround, and then from the sponsor's perspective too. I mean, obviously, yeah, if you've been doing it for 20 years, it's great, you know. But everyone's got to start someplace, right? And so I think the issue is always this liquidity issue, is that having enough to put into the deals when you need it, and those are some of the things that, you know, I'm passionate about, is that we need more participants. You need more investors. The pool needs to be bigger for everybody, and so, you know, better access to these sort of opportunities, so that when a deal is found that's worth doing, you can actually get it done and you can properly capitalize it. And you're not always in these sort of potential predicaments where, you know, you're having to take on pref equity obviously the long-term financing of course, locking in more long-term debt from the get-go is preferred. And it's, you know, and I think that is a bit of a signal too, right? Is that if a more institutional type of, you know, financing option is putting long-term debt on it right away, you know, but once again, the deeper value add or whatever, I mean, then even their risk appetite goes down. So there's all these moving parts. And so I am sympathetic to the guys on your side, is that it's, you know, yeah, are the property management fees, can they pay the bills? Yeah. But I think, like you said, I mean, you guys have got 22 employees in your property management company, right? I mean, like they show up to work every day and they need to get paid too, right? And they're adding value to the property. And, you know, and then whatever asset management fee that you're collecting along the way, I mean, it's certainly not getting you rich. You know, it pays the bills and makes it worth. Yeah, it pays some of the bills, right? So the whole nature of how everything works is that there isn't, as much as everyone wants sort of great alignment, there is just this inherent misalignment, right? And I think it's appreciating that from, if you're a passive investor in LP, you know, appreciating those things, that, yeah, it would be great if you could just do deals with sponsors that just had $5 million in cash sitting in the bank. Great. You know, okay, if that's your criteria, you know, you're going to whittle it down pretty quick, because most guys that are active, they're real estate rich and probably cash poor, because they're always putting their money out in pursuit costs, or they've got the money tied up in the deals themselves with their co-invest, right? And so it's I think for both sides of the aisle, just appreciating what the others are dealing with. And that's why for me, it's like cutting through some of that to get down to, like, at the end of the day, what really matters is that, was it worth buying that property at that price? Right. And can the person who's running it execute the strategy? Is what their pro forma says, can they do it? And that's how everyone should be measured, is their ability to pull that off. Now, we've obviously been on this enormous bull run, so everyone looks like freaking geniuses. And, you know, who knows, but I'm going to go on a limb and assume that they're not 100% geniuses. I think a lot of people just, you know, they ride the wave, and we're about to find out, you know, probably who was, and, you know, who are actual geniuses and those who aren't here with the pandemic fallout. But, you know, I think that, yeah, those are how these things get financed is a big deal. So when you go in, and you kind of hit on this too, is that you're adding value, whatever it is, whether it's $5,000 a door or $40,000 a door, you know, there's materials, and there's humans that are showing up every day, you know, laborers to get this stuff done, subcontractors. How do you guys deal with that? I mean, I know that I'm not sure what the San Antonio market is, but that's always been an issue, right? It's just the labor crunch, right? Are there enough resources to go around, and how do you keep those guys sort of focused and, committed to what you're doing? How do you guys manage that?
Yeah. So we've done kind of every facet of, I guess, construction, from, ground up new construction to really heavy redevelopment on multifamily. My favorite thing to do is to buy a property where you've got some interior updates that are going to drive your NOI, right? So you take a rent from $850 to $950 by renovating the interior. Now, you might have some exterior stuff, parking lot or new monument sign, that you're going to third party out, right? So, okay, listen, we need to paint the building, and we're not going to have our maintenance guys do that. It's a huge job. Or we're going to redo the parking lot, and we're going to bring in get 3 bids or use a preferred vendor to get that done. Those big projects are kind of easy because it's just kind of, one and done. The interior is where the kind of magic happens, right? That's what the lenders want to see. That's what we want to see. That's what investors want to see is, what are we doing to take this kind of classic unit that's a little bit dated? How much of that can we do in-house, right? Can we order 10,000 cabinet pulls at one time and share that across properties? Can we have the paint done in-house by our maintenance crew? Can we do this vinyl plank flooring in-house? So trying to keep as much of those unit, I wouldn't call them unit turns. They're a little bit heavier than that. It's a unit renovation, but if we can keep that in-house and kind of have a programmatic approach to these upgrades, because a lot of time, if you're buying a property that's 92% occupied, you're not going to have 50 units to go in and renovate. You're going to have to do them as they come up. We're going to try to get somebody in a classic unit moved over to an upgraded unit, so we can capture that premium without having to bring somebody else new in the door. So that's, I think, been a key, is just using the on-site maintenance guys for as much of that work as we possibly can. And then, dealing with vendors is always it is what it is. I mean, you're going to have good ones and bad ones, and sometimes the good ones turn into bad ones, and there's just kind of a constant maintenance of that kind of vendor roster to get that stuff done. But, to answer your question, I think what we do is, and a lot of operators do, is put it in 2 buckets. You have your exterior bucket, which you can knock out and have some pretty big kind of aesthetic impact on the property quickly with one vendor. And it might be a big check, but you can get it done. And then the interiors, the nice thing is, on an apartment community, if it looks good on the exterior, great monument sign, great looking office, professional staff, and a good walk path to a perfect model unit, well, the property could be 99% unrenovated on the inside. Nobody's ever going to see it, right? So we just want to have that experience for that new prospective tenant to be perfect. And then, we can programmatically upgrade the interiors using as much in-house, labor and materials as we can to keep costs down.
Yeah, no, it makes a lot of sense. So what are the things that you see, your peers doing, not to throw people under the bus here, not asking to name names, but like, what is the stuff that you see other sort of multifamily operators doing that just like terrifies you? Or stuff that because, I think that the other thing I've learned from just being in this business is that it's funny how everyone does feel like they're competing for dollars. I mean, whether people admit it out loud or say it out loud, it's just, that's the sense I get, is sort of a dollar that goes to some other multifamily syndicator or whatever is a dollar that didn't go to me. Right. It's a bit of this odd zero sum sort of game that they think they're in. So anyway, it's just, but I'm always interested in, like, what, from your purview, you obviously see people doing stuff. They're buying properties, they're doing whatever, and so I feel like that puts you sort of in this LP or passive investor sort of seat. But what do you see people doing today or have been doing in the last year or so that you're just like, oh my gosh, like that is terrifying. Like, I can't believe they're doing that. And what is it?
So I guess 2 things come to mind. One is, there's a lot of great educational content out now, and it's pretty easy. I don't want to say easy, but to structure multifamily deal, there's a lot of focus on the structuring the deal, raising the capital, and closing, right? Almost to the point where somebody new would not, would think that maybe, hey, this is like the business, right? You get a pitch deck together, you talk to investors, you raise capital, you close the deal, time to celebrate. And really, you don't celebrate getting to the starting line of the marathon.
Yeah.
I mean, that's not when you celebrate, right? So, seeing people get into a deal, I guess because they can, not necessarily because they should. And then the other thing is back to that capitalization. Look, I'm an LP on some deals where, and in some cases, a guarantor where I've had to write checks to keep the project going. And that really rubs me the wrong way, right? When I've got to come help a sponsor out with liquidity to push a deal along that they either didn't have themselves or they didn't raise, that drives me crazy. I don't know if that scares me to death, because I've done too many real estate projects, and the death of it is letting it sit without progress. So I'd rather inject capital into a project that I'm a partner on to push it through to that next phase, whether it's a refinance or a sale or a bank draw or whatever the case is. But when a sponsorship group buying a big multifamily asset can't inject a little liquidity, that drives me crazy. As an LP, as a GP, on deals that I'm a part of that I don't run, right? So that's it. And then there's kind of some of the underwriting stuff, extremely aggressive rent growth projections. I mean, you can make any deal look good there. A flat cap rate at exit, you can make any deal look good if you're buying at a 5.5 cap and you say you're going to sell it at a 5.5 or a 5, which probably could happen. But if you underwrite that way, it's going to make anything look really good. In terms of underwriting, I mean, you could pick it apart. A really aggressive renovation timelines, really aggressive year one rent bumps, because you're going to get in there, and depending on the property, even if it's performing well, you're going to run into some stuff after you buy that property. You're going to run into some challenges. You just got to expect them and be ready for them. And it's not just going to be this perfect takeover and smooth up and to the right starting day one when you get in there.
Yeah, because it does seem a bit like that some of this ends up being positioned as though it's, this so, I mean, it feels to me like it's a bit of a misnomer that, I mean, obviously in the later years, it is a cash flowing investment, but a lot of it, they make it sound like it's like cash flow day one on a value add multifamily, which is it doesn't seem to, yes. Is the property cash flowing? Yeah, it's 92% occupied, whatever. It's not to say it's not, but you're in this renovation period. So to your point on the liquidity, you've got this budget and these reserves or whatever, and you're trying to do it, but is it really maybe you guys do it, but it just seems that as an investor, you're better off just thinking, listen, yeah, will the property be cash flowing? Yes, it will. But that's different than you receiving a distribution, right? Like, I mean, and so it seems like they get conflated oftentimes. And it's like, okay, if it's a core deal that just buying, it's already stable, then yeah, I mean, I would expect fully that I should start getting checks pretty much right away. But otherwise, sort of, it's more of like, let them execute this strategy, renovate the units, and you get through that part of it, which of course that's risk. I mean, renovation risk, construction risk.
Absolutely.
You're being compensated for that. That's why the pro forma says 18 IRR and 1.93 multiple, right? I mean, if it was, it's just. Do you see that where you think that there's some confusion there with investors that somehow think that the checks just start immediately, even though that's not reality?
Yeah, for sure. I mean, we've done kind of every gradient in the spectrum, from, hey, there's no cash flow for 2 years. This thing's a war zone, but here's the average annualized return and it works for everybody. Or, hey, year one, no cash flow. That's just not happening. We got too much work to do. We have done some deals that are bigger, cleaner, where we've got, we can start cash flowing right away. That's nice. But who wouldn't want that, right? Who wouldn't want the big IRR and cash flow day one? Sure. And not to say that can't exist, but
yeah.
It's deal by deal. And you've got to understand, I think, as a passive investor, which is it? And, be willing to accept a trade-off. If there really is a heavy lift that year one, man, we're going to kind of need all hands on deck and all the capital focused on getting that property transitioned.
Yep, definitely. So for you, I mean, what is the biggest sort of real estate investing blunder you've ever made, or like the one that you wish you could take back?
Yeah, I've got a bunch. A lot of stuff flipping houses. So I've flipped hundreds of houses in my kind of career. Lost money on a few, mostly kind of contractor related, right? The wrong contractor, stuff like that. thankfully, I don't flip houses anymore. I think the answer to that was just stop doing that.
Yeah.
This year, 2020, we got into contract on a $20 million plus deal at just the worst week of the last decade, I say.
Yeah.
And I had $250,000 earnest money up, but 100 of it was hard, and I walked away from that deal. So 100K earnest money, poof, gone in the wind. If I could take that back, I totally would. I don't let that get me down too much. I kind of frame that to myself that listen, I'm swimming in the deep end. We're playing with the big boys, and sometimes that happens. The thing for me is always that we've never lost investor capital, right? And so everything's kind of set up around investor delivery, meeting our pro formas or beating them, right? And so I've taken some hits, some losses personally, but we haven't lost investor capital. I think just because, like any good operator, we're really, really conservative on the way we structure the deal, the way we approach the deal, so that we never have a capital loss for an investor.
Yeah. Yep. Yeah. And that does seem like when it is. It's just when you get aggressive and you press and and it's hard because some of that stuff works. That's what I mean. Like the numbers are more flashy. It's alluring. We're human beings. We can't help ourselves. Right. But it's like, that's the stuff, man, that you got to resist it. And that's what my hope is, like with this podcast. It's just like, you just got to slow down. I know that it can get exciting, because it can, if you got money and you're looking at a deal and the pictures look really pretty and all that stuff. Like, I get it. I mean, I totally get it, but you got to just slow down, right? Don't let the scarcity of because once again, the sponsor, it's legit. Like, hey, we got to raise this money by whatever, and, get in now, or, whatever, you're not going to get in, but
right.
You got to slow down, and you got to think it through, and you got to just picture it. This is an apartment building in San Antonio, Texas, that's located here. And this is what it was. And think through what you've got and look at that pro forma and just ask yourself, does it seem reasonable to you? Like you mentioned it. It's 92% occupied. So how can you push rents? How are you going to increase the rents on all these people that have more than likely 1-year leases? I mean, you can look at the rent roll. You can see when they roll off. Yep. That's all data that should be accessible to you, right? Yep. Because once again, that's the data that the guy who's going to do the deal has been using to make their decisions. Right. And if you don't have that data, or you can't slow down and take a look at it, it can be scary. It can be intimidating. It's spreadsheets, it's things like that. But, the more you do it, then you learn how to sort of get through that stuff quickly. And then you just have to ask yourself, like I said, it just comes down to, does this seem reasonable? And does it seem like this particular group can execute? Right. And do I think that I'm, at whatever it says I'm going to get, do I feel like I'm going to be compensated for whatever risk it is that I'm taking on to do that? And, once again, every person has to make the decision for themselves, because, it should be solving a problem in their own portfolio, right? Like
100%,
right. Yep. It's, if you're looking for cash flow and the deal's not going to cash flow for 3 years, then it should be pretty simple. That should have been a no-go from the get-go. But, yeah, very good. Well, yeah, it's been great sort of catching up here today and kind of hearing and getting deep in the mind of Devin and how you've sort of approached these things. And it's always interesting to hear. And I love for most of them, it ends up being, it's like I said, it's pretty simple. When you take a conservative approach, it's sort of like not in a rush to do anything. It actually, you realize that it isn't that complicated. But it's just a lot. It's all about execution.
It really is. And multifamily is messy, so it's one thing to underwrite on the spreadsheets, another to go out and hire that leasing agent that's going to have an incredible responsibility for a huge amount of capital. So, making all those pieces work is where the magic happens, right?
Yeah. Very good. Cool. All right. Well, you take care. Thanks again. And we'll be in touch.